Hi, I'm Austin Eaton with Coldwell Banker Burnett, and I'm here today to bust a couple myths about borrowing to buy a home. I was at a dinner party over the weekend, and the conversation made its way to real estate and what's going on in the real estate market. And I started talking about how millennials now are the largest segment in the market. Over 40% of buyers these days are in the millennial generation. One of the people I was talking with has two kids who are out of college and is starting to think about, okay, how do I get these kids out of the house and into their own place? And how can they afford to buy a home? The question was, how can they afford to save 20%? Or how do they do it? 20% for a down payment. And I thought, wait a second. You do realize that you don't have to save 20%. It's wonderful to have 20% down. Don't get me wrong. That's the best way to buy a home, to have at least that much in the deal. But there are plenty of loans now that are written with way less than 20% down. And let's talk a little bit more about that. Got a couple graphics here that'll help us. First off, 61% of home buyers in 2017 put down less than 6% to buy their home. 82% of the VA loans were 0% down, and that's a great benefit for the veterans who have helped our country so much. So I'm happy for that. It's a great program. The average first-time home buyer had a down payment of less than 10%, and there are many programs that help us and help buyers achieve those reduced down payments. FHA, which is a federally insured loan, is a great way for buyers to come in at 3.5% down, and sometimes even less. The Minnesota Housing Finance Agency also helps with down payment assistance, and they don't actually make the loan. They coordinate with the lenders to make sure people can qualify and get assistance in getting a down payment down, or being able to finance the closing costs. And then there's private mortgage insurance, which comes into most loans that have less than 20% down. And you pay a little premium for that on a monthly basis, but it allows you to have less than 20% down in the deal. As we move down here, you look at credit scores. Credit scores are often thought to be the key to getting a loan, and yes, they are. You need to have decent credit, but it's a lower hurdle to entry than some think. Over half the loans fell between 600 and 750. And if you look across these graphics, obviously you want to have the higher score, and there are more people at the higher scores, but you can still qualify under the magic 750 mark. Next piece of this would be how many years it takes the average consumer to save save 3% toward their loan. And in Minnesota right now, it's 1.6 years, taking the average home cost and the average wage to calculate that. And then if you look at that and go, oh, wait a second, here we go again. Everybody can qualify for loans. Here comes another problem with lending. And that's not the case. If you look at this chart, at the top of this peak here, that's when everybody could qualify for a loan. If you had a pulse, you could get a loan. In fact, there was a dog that qualified for a loan. I kid you not. Then, when the whole housing crash came and mortgage crash came, the restrictions for getting a loan were tightened up dramatically. If you look down here toward the bottom of the graph, you have restrictions on qualifying for loans, and it has not eased up a lot. There is still increased ability to get a loan, but you need to be qualified and need to go through the proper channels. So feel secure in the fact that we are not going back to the early 2000s where everybody could get a loan and the market suffered from it. So if you found this video interesting and helpful, I would love to be a resource for you or anybody in your family. Please share this video. Give me a thumbs up down below, and let me know if I can help you or anybody you know out. I'd love to be a resource for you. Thanks so much for watching.